And welcome everybody. Welcome back to Sectors Made Simple. Today, I want to talk about a type of strategy that can be very, very valuable to us, especially when there aren't many opportunities for us to find in the market. The reality is the stock market is not just about the market going up. There's a lot of ups and also downs in between. But when there is room for opportunity, there is room to learn strategies to capitalize and profit off of that opportunity. So I want to share some ways that we can do that today. Before we get into it, really quick disclaimer. The goal today is to provide you with education and resources to help you learn. The goal is not to show you the only way of doing things, and the goal is not to provide any sort of recommendations for what you should buy. Ultimately, the goal today is to show you a way that we can think about investing so that you can look at the data yourself and have a guide for how to make more informed investment decisions. That is our goal here. Help you make more informed investment decisions simpler, with less choices or more time saved. So today is all about finding opportunities in the market. Mostly, we're talking about market recovery. I want to talk about what market recovery actually means and what it looks like, how we can use something known as BPI or bullish percent index to track that market recovery. Then we're going to look at how we can read BPI using one of our tools, the Sector Explorer, and how we can use it to find what areas of the market might be providing us with new opportunities, especially when the market is going down or certain areas of the market are going down. And we'll look at strategies in 3 different ways. We're going to look at sectors and sector ETFs that are creating opportunities. Then we're going to look at how we can find companies that are already on breakout, meaning these are opportunities that we can take advantage of right now. And then finally, we'll talk about how we can create a watch list of companies that might be the next to go on a breakout. All of that and more in this webinar. But first, why should you care? Why are any of these strategies something that you should probably learn about, in my opinion? Well, when the market's going up, it's really easy to throw our money almost anywhere and see a profit. The reality of it is, when the market's going up, it is simple to invest. But the market's not always going up. In fact, it spends a lot of time either going down or trying to recover from its losses. Because losses in the stock market are not an if, they're a when. Pullback, losses, these are things that are normal in the stock market, and we should be prepared for them. So how do we figure out when that negative time, those losses end? Well, you might think that the easiest way to figure out when the sky's all clear and the tank is clean is if we just waited for the market to hit new highs. If the market's going down, sure, I don't want to invest it. But if the market's going up, is it actually creating new highs? Is it creating new value? Or is it just trying to recover what it had lost before? Well, if you're waiting for those new highs, you might be waiting a long time. And you're probably going to you will miss some of the best days in the process. In the past 20 years, 42% of the strongest days for the S&P 500 have happened during bear market, when the market is going down in general, or when it is recovering from those losses. And another 36% happened in the first 2 months of a bull market, which means 3 out of every 4 opportunities that the stock market has provided have happened when the stock market was either in a bear market and trying to recover from it, or recently recovering from a bear market. Which means we should probably figure out ways that we can find those 3 out of 4 opportunities. So that's what we're going to look at today. Because what goes down will come back up, for the most part. The stock market, at a high level, is always going through a cycle. It is going up, it stops, goes down, goes back up, and that cycle repeats itself. Bull markets, market highs, bear markets, market lows, and back into bull markets. Which means bear markets are not an if, they're a when. But bear markets are just an extreme example of market pullback. That's just a term for when stocks are generally going down. The technical definitions, for those interested, a loss of 10% from a high is considered to be a loss of 20% or more is considered to be a bear market. A loss of 10% or more is considered to be a correction. And these happen fairly frequently. Every couple of years, we will either see a bear market or a correction. But historically, the stock market has always recovered from pullback, bear markets, and corrections. And the beauty of it is that the pullback, those losses create opportunities. Because when something is being sold, people are selling and selling and selling and selling. And then all of a sudden, they realize that they probably sold a little bit too much. And things begin to recover. But there's 2 challenges that come up when we're thinking about pullback. First, there's no magic you are here for the market cycle. We invest in the stock market day by day, and it can be really tricky to figure out where are we in this cycle, because the cycle is not pretty or clean or something that you would like to see in a textbook. The market is messy, it's dramatic, and it's emotional. So we should try and figure out a way that we can learn where we are in this cycle, but also when those opportunities are beginning to pop up. Because it can be really tough to figure out when we should be looking for opportunities, and also where we should be looking for opportunities. But the beauty of it is, with Sectors Made Simple, we can track both of these things. We can figure out where in the market cycle we are and how we can find opportunities when recovery begins. Really quickly, let's talk about what actually causes pullback, because these are things that we will see on a day-by-day basis. It can happen for a number of reasons, both within the market and outside of the market. Bad economic reports. For example, if inflation is going up, or if GDP is going down, those are negative things that will hurt the stock market. Or if the reports are missing entirely. But also, more connected to the stock market is if people start to think that stocks are overvalued. This idea that we should be paying a certain amount for a company. Now, how much that is depends on the stock. For example, Palantir or Nvidia, you're paying way more per share than you would for most other companies. So, the question then becomes, what's the company worth to you? And that's something that every investor will think about. And at a certain point, the price will go up and up and up and up until people decide that it's a little bit too expensive. And then it'll go down. But it usually doesn't go down to what is fair. It continues going down because people get caught up in selling. And then also, the reality of it is, the stock market tries to predict recession. We like to think that we can put our money in a safe place for if a recession happens, or more appropriately, when a recession happens. So if investors feel that a recession might be coming up soon, they're going to move their money out of the stock market, and stocks are going to fall and lose value as a result. Now, sometimes this pullback is temporary or short-lived. It can happen for a few weeks or a few months. So, this is something that we should be prepared for. But also, how do we figure out the risk? Risk is an important part of investing, especially when we're trying to invest long-term, where we do care about the ups and downs of the market. And one simple answer to that is to use BPI, or Bullish Percent Index. This is a topic we've covered a lot here at Sectors Made Simple, so I'm going to spare you a full webinar on BPI because we've done that before. And we're just going to focus on the important summary of BPI. It is a percent from 0 to 100. And that percent tells us what percent of companies within a group are currently creating new highs, also known as a breakout. We can do this for any group of companies. We can do this for large cap companies, companies that are really, really big, small cap companies, companies that are pretty small, but also we can do this for market sectors. And that is where we're probably going to focus the majority of our efforts today. The reason is because companies within a sector tend to move up and down in price together, which means if we are able to track BPI, we can start to figure out if some companies start to go down, and if some companies are starting to go down, the fear is that more companies will follow. Reading BPI is very, very straightforward. And it's something that you can find on a couple of different websites, but in limited forms. But with Sectors Made Simple, we offer sector BPIs for a wide range of different groups. You can check out sector BPIs for the S&P 500, the NASDAQ, the New York Stock Exchange, or the entire stock market. And when we're looking at BPIs, we care mostly about two pieces of information. The actual percent. What percent of companies in that sector are currently on breakouts? And also the direction. Is that percentage going up or is that percentage going down? X's tell us that it is going up. If you don't want to remember the letter, that's fine. It's in green. Green going up. The opposite would be O's, which is the BPI is currently going down. You don't want to remember the letter, that's fine. It's going to be red. I want to give you a quick example. Let's go and take a look at the communications sector. If we go to the dashboard, which is dash.sectorsmadesimple.com, on this page, on the left side, there is going to be Sector Explorer. I'll post a link in chat for those that want to follow along at home. On this page, if I quickly refresh, we'll find the BPIs for a bunch of different groups. But the one I want to see is communications. Here, what we see is that communications currently has a BPI of, if I make this a little bit bigger, of 43%, which means 43% or 43.3% of companies within the sector are currently on breakouts or buy signal. But that number is going down because we have that red O column. So 43% of companies in the sector are currently on breakouts, and the column is O's, red, meaning that percent is going down. More companies are going on sell signals or breakdowns than buy signal. These two pieces of information give us everything that we need to know to get started with BPI and to use BPI as a way of figuring out where in the market can we find more risk or opportunity? BPI can be used for risk, because if our goal is to find the risk or opportunity of a sector, we can use BPI like a thermometer. It is from 0 to 100%. And the higher the BPI, the higher the risk if, but also when, that BPI starts to go down. If more companies are on buy signals, there's a lot more room for that sector to fall when pullback begins. If you want a very easy rule to use, think about it in 3 different zones. Anything with a BPI above 70% is in the danger zone, where if that number starts to go down, there's a lot of room for it to fall. This we consider the more risky areas of the market, because there's a lot more room for losses. But the opposite can also be true. One example of an area of the market currently that has increased risk would be mega cap companies. These are companies with a value of $200 billion or more, where right now 70% of these companies are on breakouts. Now, does that mean that this sector is a bad sector? Or rather, this group is a bad group? No. But what that does mean is if and when that BPI starts to go down and reverses from the green X to the red O, there's a lot more risk that that trend continues. Meaning, there's a lot more risk for losses. But again, while BPI can be a great indicator for risk, it's also a great indicator to find opportunity. Because while a BPI above 70% is a risk indicator of high risk, the opposite's true, where a BPI below 30% is an area of opportunity. Because there, most of the companies in that group are on breakdowns. They're on sell signal. So, if we watch those BPIs, we can find when a BPI reverses into X's, meaning that more companies are starting to go on breakouts. And if some companies are starting to go on breakouts, the hope and the goal is that others will follow. Because recovery doesn't happen overnight, and it doesn't happen all at once. Certain sectors, certain types of companies will show recovery before others. A wave has to start somewhere. So I want to take a look with you at the Sector Explorer, that tool that we were just looking at, and see if we can find any sectors that have higher opportunity right now. To do this, we're going to sort by lowest BPI and see if we can find any sectors with these lower BPIs. So, if we head on over here, what we can do is click on the current BPI to sort these from lowest to highest. Some of these are going to be based on how big the company is. For example, nano cap companies, the smallest companies that are still listed for us to invest in, only 18% of those companies are currently on breakouts. And that number is currently going down. That is not an area of opportunity. What is would be the staples sector. These are the I needs in life. Your big department stores, your Costco's, your Targets of the world. And what we find there is that 32.5% of staples companies are on breakout. 1 out of every 3. But that column is green, meaning that number is going up. So, we have now found one sector that has a very, very low BPI and that BPI is going up. 2 out of every 3 companies are not yet on breakouts. That's a lot of opportunity. But is that the only sector? Well, if we keep looking, we find technology has a BPI of 36%, and it's in a column of X's. Discretionary is at 41.2% in a column of X's. Now, if you're super adventurous and want to take a look at some stock charts, I'll show you how we can figure out even more detail. If you're not interested in stock charts, bear with me for 30 seconds, close your eyes, or follow along. Because if we click on any of these sectors, we can open up the chart to see how that BPI is changing over time. So what we can see here is for the technology BPI, the BPI went as low as 24%, and that was on November 17th. Then, on December 1st, the BPI began to go back up. So here we had a reversal below 30%, creating that area of opportunity for us. And since then, we have had 10% of companies within that sector go on breakouts. It is very common for us to see these trends occurring, where we see a BPI below 30% begin to recover, and a lot of companies following in that trend. Or we can take a look at let's go look at Staples. Not the company, the sector. Here, we caught it even earlier, where we had a BPI begin to reverse, and that reversal has happened only over the past 4%, meaning that it's happening a little bit slower, but there is still tons of opportunity for us within this sector. So, is this something that you should check every single day? Probably not. Because a lot of these trends happen fairly slowly. For example, let's go back and let's look at technology. What we can find is we can see how fast these trends are happening. For example, everything past C are things that have happened in December. B was November. A would be October. So the technology sector spent 2 months with more companies going on sell signals than buy signals, breakouts than breakdowns. Before that, it had spent all of September going up. It had spent all of August going down. These are not trends that are changing every few days. These are trends that are changing over weeks or months. So if you had to ask me, when should I start to pay attention to BPIs? Well, my simple answer would be start paying attention to BPIs when the market is actively going down, when there are less obvious opportunities for us to invest in. Because by following these BPIs, we can get an earlier indication of when recovery begins. We're not finding a sector when the majority of companies are already doing really well. We're finding these opportunities as early as we can, because we're finding when just a handful of companies are starting to go on buy signals, with the goal that more companies will follow. And I was asking, can we check the BPI by company, or does it have to be by sector? That's an amazing question. Give me an example of a company you'd be interested in. Because yes, you can look at the individual companies within a group. For example, within the technology BPI, I could go here and I could sort to only show me companies that are on sell signals and their prices are currently going up in a column of X's. That's one way we can do it. Or we can also search for a specific company. So if there's a company you're interested in, I'd love to take a look at that, and we can show how we can connect all of the dots. Because yes, we definitely can check BPI by company. So if there was a company you're interested in, let me know and we can look at that together. Tesla, great. So if we go here and we search for Tesla, what we get is the point and figure chart for Tesla. This is just the normal stock chart. But I'm going to make this a little bit bigger for all those playing along at home. We also tell you some basic information. What sector is it in? Consumer discretionary. Is it a stock or an ETF? It's a stock. What exchange is it in? NASDAQ. And how big is the company? It's mega cap. It is real big. But below that, we tell you what BPI groups that company is a part of. So it is part of 4 groups. It is part of the NASDAQ discretionary. It is part of the NASDAQ mega cap. It is part of the discretionary sector. And again, mega cap. So we can look at the entire stock market and its sector and company size, or specifically just its exchange, both by sector and size. If I clicked here, for example, we've already looked at discretionary. Let's click here on all mega cap. And what that will do is it will quickly load up the BPI chart for that specific group. So here we would be able to see the BPI chart for all companies within the mega cap group. And that number currently is 70%, but that number is staying pretty high. It has not begun to go down yet. Now I could go in here and I could see how many of these companies are currently going down, but that's a story for another day. But the answer to your question, 100% yes. You can look at an individual company and then see what the risk of that company's size is and that company's sector. 2 amazing pieces of information when we're thinking about buying something for the long term. Jonathan, can you tell exactly when it turned to an X on the point and figure chart? Yes, you can. For example, the mega cap BPI. Let me make this a little bit bigger for all those playing along at home. Is currently at 70%. And that number used to be 42%. When did it start? When did it start going back up from 42%? If you hover over the X, whatever box you're interested in, we tell you what date that box happened on. So, for the BPI for mega cap companies, that number started to go up on November 25th. How about the last time we had the BPI reverse from 70%? Because that did happen, and check this out. You want to tell me that BPI is useful? Look at this. On November 5th of 2025, 70% of mega cap companies were on breakouts. That number started to drop like a rock and fell all the way to 36% between November 5th and November 17th. 2 weeks, 40% of these mega cap companies went on sell signals. That number tried to go back up, went back down a little bit, and then has been going up ever since. These reversals, where we have a number start off high and fall very low, or the opposite, are very common trends and are the reason that we like to follow BPI. It is not something we need to look at every day, but when we're looking at the market and we're not finding as many opportunities as we might like, this is one way that we can spot opportunities quicker. We can cross-reference that day with our candlestick chart. It formed a banner, 100%. All of this information that we're seeing here can be the start of a lot more analysis. And I'll actually hint at a couple of the different ways we can do that today. But for those that are just trying to get started with getting more involved in companies, we don't have to look at stock charts. If you want to look at stock charts, don't worry, I've got some education for you on that. But if you don't want to look at stock charts, but you still want to enjoy the trends, you can also do that, and I will show you how we can do that in a couple of minutes here. I use BPI exclusively. It is a great indicator. And with the Sector Explorer, we have lots of different ways that we can look at BPI. For example, it is not relevant to today, but I want to show you this because it is fascinating. Right now, large cap companies are performing better than small cap companies. The bigger the company, the better it's doing. Mega cap, 70% of companies are on breakouts. Below mega cap is large cap with 64%. Below that would be mid cap, 61.9%. Now we have small cap, which would be 52.3. We're starting to go lower and lower here, right? Below small cap would be micro. Guess what? We've now flipped from X's, where the BPI is going up, to O's, the BPI is going down at 33%. And the worst performing group at the moment would be nano cap companies at 18.5%. So right now, there is an obvious trend. Mega cap companies are rocking it. Micro cap companies are falling behind. And that is a very clear trend from top to bottom. But just as there is more to know of where they are right now, that also means that if and when those trends reverse, mega cap has a lot more risk, micro and nano have the most opportunity. That's the beauty of BPI. It can be risk to help us understand the risk of a group, or opportunity to find where the opportunities might be. But for right now, let's go back to the opportunities, because that's really what we want to be looking for when we're investing. So if we look to see what sectors were below 30% or were recently below 30% and are in X's, we found those three sectors: staples, technology, and discretionary. Great. 3 sectors. What now? Where do we go from here? How do we use that information to actually buy something? Well, I'll share with you 3 different ways. Starting off with the easiest way. Buy a sector ETF. By investing in a sector ETF, what we can do is we can buy into the recovery of a sector. If we see the technology sector is starting to perform better, just buy the technology sector. The beauty of that is sector ETFs, on average, will be less risky than individual companies within that sector. So, how can we do that? Well, the first step is figure out what sectors have low BPIs, but that BPI would be going up. And we've already done that. Staples, technology, and discretionary. So we could end it right there, buy all 3 sectors, and be happy. But I only want to pick one thing. So here's an easy way we can figure out which sector I'd be most interested in buying. If we go to the sector summary page, where we can see which of these sectors is strongest right now, we can see if any of these sectors are current leaders in the market, or are sectors that are gaining strength. Here, what we are doing is we're putting together multiple pieces of information. The more stuff we can use to give us thumbs up or thumbs down, the more informed of a decision we can make. And it's really, really simple. Let's go try that together. So remember, staples, technology, discretionary. Their sector ETF partners would be staples XLP, discretionary XLY, technology XLK. If we sort by total strength to see the strongest sectors right now, here's technology. It is the current strongest sector. Here is discretionary. Here is staples. Cool. As far as we're concerned, technology is the current strongest sector. Now, let's figure out which of these sectors has been gaining strength. Have any of them been gaining strength over the past week? Well, not really. 1, -1, -1. I want to see some movement. So how about 2 weeks? Oh boy, okay. We've got 15, we've got 5, and we've got 0. So if the question was which of these sector ETFs has been kicking butt the past few weeks, that answer is super obvious. Technology. It is the strongest sector in the market. It has been gaining the most strength over time, and its BPI is still showing that 2 out of every 3 companies in the sector have yet to go on buy signal. So either way, technology XLK would be our winner. This is something that we can do at any point. But now, what would we do with that information? The easiest answer, buy and hold. If our goal is to make things simple, let's keep it as simple as possible. How would I personally trade that information? I'd just buy it and hold it. I'd buy the sector ETF right now because I'm thinking about it and the signals are there in my opinion. And I'd probably set a trailing stop on that ETF, meaning that it will automatically sell itself if it starts to go down. How much? That depends on how much risk I want to take on. If I want less risk, I'd put a smaller trailing stop on it, say 5%. So if XLK fell 5%, it would automatically sell. Or if I wanted to just hold it for longer, I found the opportunity, I put in the 15 minutes of work, I'm just going to let it run for a while. We could put a bigger trailing stop, like 10%. Either way, that's all we would have to do. We find the opportunity, we decide what we want to buy and when we would want to sell it, and then forget it. See it, set it, forget it. That can be a super easy way to invest in this information. We don't have to look at a single stock chart. We don't have to do any crazy work. The steps, Sector Explorer, go see, my personal opinion, I like to use all market BPIs. See which areas have opportunity, meaning green column, low BPI. And then I would go to sector summary to help make a decision, either the current leader or the sector that is gaining strength over time. But what if I wanted to invest in companies? Remember, BPI is telling us what percent of companies within a sector are currently on a buy signal. So what if I wanted to find those companies? Well, we can. But before we do, I wanted to check the live chat and see if there are any questions, because there are. Romulo is asking, is it safer to rotate in sectors only when their BPI resets from an overbought condition? Why or why not? Great question. That is an amazing question. The simple answer to that is yes. If what we're trying to do is increase our chances of success decrease our chances of loss, the more things we can find that are strong indicators, the better. I've shown 3 ways we can do that. BPI, the BPI is beginning to recover, like with technology, or staples, or discretionary. If those sectors are a current leader or are gaining strength. But the same thing can happen in the opposite direction. Let's see if there are any sectors that are currently overbought. And the answer is all of these are based on the company's size. Oh, sorry, I was looking at the wrong table. My bad. What we find is, oh, hey, look, the utilities sector. Let's go take a look at it. Its BPI is 68%, and that number is going down. It started off on October 19th at 76% and has been going down since then, from November 13th to November 20th. So if I was looking at investing in a sector ETF, I have found areas of opportunity and areas of higher risk. This is a piece of information we can use in addition to almost any other type of strategy. If we're interested in buying a sector ETF or even investing in a sector, this is information that we can use. Because BPI isn't just about when we see a reversal, it's about figuring out the risk if, but also when a reversal happens. Great question. So now we've looked at a strategy buying an ETF. Let's take a look at companies. Because here our goal is to find companies that are in a recovering sector. One of those 3 that we've already looked at. But they have recently gone on breakouts. The reason, this strategy is great, in my opinion, for people that want to make a decision right now. Look, as much as I'd love to think that this is something we're staring at all day, we're not. A lot of people just want to invest when they have time. It's a Thursday night, you're sitting there with your computer, you've got a little bit of time, you go in, you want to find an opportunity right then. You don't want to create a watch list, you want to buy something now. This strategy is one that we could use. So if our goal is to figure out a company that is in a recovering sector, but is already prime for us to purchase, we can do that using the S&P 500 screener. What we'll do is filter companies who are currently on breakouts, because we already want them to be creating those new highs. And their prices are still going up. But there's one part that's probably very obviously missing. Sector. How do we decide what sectors to look at? Well, before we do that, let's just take those 2 steps we've already shared. On the S&P 500 screener, this is a way of ranking the 500 S&P 500 companies against each other. What we can do is see which companies are already on breakouts and their prices are currently going up. That's 186 companies. But again, we're missing the sector. And the reason that I haven't talked about that yet is that there are 2 ways that I think are, or rather that I know are valuable, depending on how much or how many options we want to have. You want more choices? I can give you more choices. What we can do is take those 3 sectors that we found. Right now it's 3. Sometimes it might just be 1, but we can put in as many sectors as we want. And that number is just based off of how many have recently reversed. How many of those X's do we find close to 30 to 40%? We'll use those same 3. Staples, discretionary, technology. So if we plugged in staples, discretionary, and technology, 64 companies. That's a lot of choices. So, the way that we can figure out which ones we care the most about, well, we'll come back to that. Because I want to share with you one more way we can filter by sector. And it's including something similar to what we've already talked about. Which of these sectors offers us the best opportunities? One way we can do that for individual companies is below the S&P 500 screener. We have sector strength averages. This tells us, on average, which sector has the strongest companies. And if we sorted by total count, hello technology, good to see you again, friend. Here's discretionary at 50%, and staples. Yes, staples is a recovering sector, but on average, it has some of the weakest companies in the market. I want to find the leaders. I want to find the strong companies that will continue to get stronger. So I'm going to only look at technology companies. And we can take our number from 64 options down to 40. Now, once we've done that, we can trade these companies on a buy and hold, or we can swing trade them. So, how do we actually figure out which of these companies to buy? This is a pretty standard strategy that we've covered using the S&P 500 screener. What we're going to do is we're going to click on signal date on the column that says signal date to see which of these companies has broken out most recently. Remember, this is a sector that more companies are going on breakouts. So we go here, we click signal date, and we can see that 5 companies went on breakouts yesterday, December 8th. 3 companies went on breakouts on Friday, December 5th. 1, 2, 3, 4 companies went on breakouts December 4th, and you get the idea. There's 2 things that I love about this. One, it lets us figure out which companies have recently gone on breakouts, meaning we're getting these signals hot off the press. But there's a second one. Let's say you are the person that just checks this every couple of nights or every night. This process to find companies we're interested in, it doesn't have to happen all at once. We now know that the technology sector is recovering. I can check back here tomorrow, or the next day, or the next day, and more companies will go on breakouts. So every single day, there will be more companies for us to consider. Because if the sector is recovering, we'll see plenty of recent breakouts, and over the next few days, we will probably see plenty more breakouts. Now, to decide which of these 40 companies we care the most about, there are a few ways we can do that. The easiest? Find a company that's broken out in, say, the past few days, and pick the one with the highest relative strength. Well, here are the companies that have gone on breakouts since last Thursday: MPWR and STX. Those are the strongest companies from this list. But if you notice, there is a handful. I'm counting, let's say, 7 companies on this list with 79 to 87%. These are among the strongest companies in the market. So we could just take that group of 7 companies and compare them directly. If we create a custom matrix out of those companies, we can take that list, compare them against each other, and see which ones have the highest strength. And then finally, for those that know how to read stock charts or want to experience reading stock charts, if you click on the ticker symbol of any of these companies, you can open up the stock chart for it. So MPWR, we can see that it's trending extremely positively over time. But it's moving pretty quick. C tells us this was the beginning of December. So, since the beginning of December, we've seen it go up on December 1st, go down on December 2nd, and then on December 4th, break out once again. This is a stock that's moving pretty quickly. Maybe you want it a little bit slower. Okay, let's go check out maybe MU. Okay, here it's moving a little bit slower. We've only got 3 columns, 3 trends in December, but I don't really like the long-term trend. We're trying to fight to create new ground here. Probably not for me. How about STX? Creating new highs, moving fairly slowly, but again, still below our previous highs. This is where the world of stock chart analysis can come in, and is a skill that we can teach you. If you want to learn how to read these point and figure charts and be able to figure out the trends within them, I highly recommend going to our Learn site. The link is right here on the dashboard. And under paths, we have our path on charting basics. So right here under charting, you can learn all about the different types of stock charts that there are, including line charts, bar charts, one of the most popular, candlestick, and in my opinion, one of the most useful, point and figure. All these videos are available for you to enjoy and are short, quick videos that you can enjoy on your lunch break, whenever you have 5 minutes, or whenever you're ready to learn a new skill. So, we can start off very, very simple. Just pick one that has very high strength. Or, as we build up our confidence and our skills with studying stocks, we can get more information out of it. If you've gotten familiar with our tools and creating things like custom matrices, that's an easy way to not have to look at a stock chart, but to find the best of these leaders. If you do know how to read stock charts, go check it out, because these stock charts are the best way to see the whole story. Jonathan, let's go shopping on Thursday. Be with me and let's go through some of these steps and buy something. I love it. In our Thursday webinar, which will be offered in Spanish, we'll go and take a look at exactly that. We'll go and look at some of these BPIs and share with you all how we can study these stock charts together. Voy a repetir esto en español porque este webinar va a estar en español. En la reunión de SMS Español este jueves, vamos a explorar las oportunidades que hemos encontrado en esta herramienta y cómo podemos usar BPI y los otros indicadores en el dashboard para encontrar compañías que podemos comprar ahora. Cool. Now, let's wrap things up by covering the third way we can use BPI. We've talked about buying the sector that is the strongest. We've talked about using or finding the companies that are already on breakouts. Let's wrap it up by finding companies that might be the next to break out. So if the BPI is going up, and companies are going on breakouts, we can find a list of companies that might break out next. I kind of answered my own question there. But the tool we're going to use for that is Swing Trade Setup. The Swing Trade Setups tool lets us figure out when these companies are approaching those breakout levels. It's a whole way of studying stocks known as support and resistance. Again, if you're interested to explore that, learning paths will be your friend. But the way we're going to use that information is that we can figure out which companies are getting close to those breakout prices. The way we would do that is we would use the setup type potential breakouts. And we want their price to be going up in an uptrend. Depending on how you've set up your dashboard, it will either be X's if you've got it to show point and figure, or an up arrow if you prefer not to see point and figure. For me, I've got it set up without point and figure, so I've got the up and down arrows. Setup type, potential breakouts. And now our sector, or sectors in this case, would be those recovering sectors from earlier. Stay with me. Staples, discretionary, technology. We can put in all three. We could just choose one. It's totally up to you. With those filters, we have 43 companies that we can consider. If we only looked at technology, we've got 12. All of these companies have prices that are currently going up, and they're getting close to those breakout prices, which means we now have a list of companies in those sectors that are close to breaking out. And we can find opportunities for these companies and pick them up right as those breakouts occur. Because if the BPI is going up and companies are going on breakouts, oh, my apologies. That is the same slide again. What I meant to show, though, is that what we can do is go in here and create a watch list out of these companies. We can go in and figure out ARW. What would the breakout price be? $114. Add it to a watch list. ASX, $16. Add it to a watch list. CLS, $344. Add it to a watch list. The resistance price, if it goes above that resistance price, that is a new breakout. We haven't had to look at a single stock chart. Now, for those that are adventurous or just want to see some stock charts, we can also look at the stock charts. And what we've done now is we've given ourselves a short list of companies that we can consider. So we can go in here and say, ARW, do we like the chart? I don't. I don't like this big spooky downtrend that we've seen over time. How about ASX? Now we're creating some new highs. It's moving fairly slow though. The last downtrend started in November and went throughout November, and this uptrend started in December. So if I want to find something that's moving quick because I want to swing trade it, probably not my choice. If I wanted to find something to invest in that's not going to be the thing I'm worried about and waking up in the morning to check what it's done, could be a good option. Now we could look at FTV, not really going anywhere. NET, trying to recover, way below its previous highs, and so on. The more experience or the more tools you know how to use on the dashboard, the more ways we can find confirmations of buy signals or opportunities, or signs of risk, or things to say, maybe not the best choice. But regardless of what level of detail we look at here, what we're doing is we are learning how to make informed investment decisions, where all of this starts off with the same idea. The market's going down, or an area of the market is going down. And guess what? It's hard to find a strategy that we can put our hopes and our investments into because the easy money's gone. But we're not going to sit around and wait for those new highs, because if we're going to wait for that, we're going to be waiting a long time. And we're going to miss some of the best days in the process. The Sector Explorer and BPIs help us to find where those opportunities are quickly and easily. These are not something that you need to check every single day. But when you're looking for opportunities for what to trade, and you're falling a little bit short on ways you can invest, this is an amazing way to find opportunities. Whether you want opportunities to diversify and decrease the risk, we can look at sector ETFs. Find something to buy and hold, individual companies, or find your next swing trade opportunity, finding potential breakouts with swing trade setups. All of this is using BPI as the basis, as the foundation that we are now building off of. How high you build and what you decide to accessorize that building with, that's up to you. And that's the beauty of it. This is an amazing way that we can take one piece of information and either create entire strategies that is the start, middle, and end of your decision for what to buy, or simply saves you time and helps you find the right place to look and focus on your analysis. So, I hope you all have enjoyed this dive into BPI, the Sector Explorer, and how, using market recovery, we can create opportunities in the market and truly find that there is always a bull market somewhere. If you have any questions about these strategies, want to see how these strategies or tools can improve your investment style, or if you just want to chat with me directly, you can always send me an email at support@sectorsmadesimple.com. I want to thank you all so much for joining us. We hope to see you all back for our webinar next Tuesday, where we will continue our conversation about ways we can use our tools to invest simpler. Thank you all so much. Hope to see you all back next Tuesday or in our SMS Español webinar this Thursday. Thank you all so much. Take care. Bye.